Hey guys, just want to make a quick video right now, which was, I've spent the last couple of weeks analyzing about anywhere between 10 to 15 banking reports, especially the con call reports that have been released in October and November, because the quarter two results have been released by all the companies right now. And one of the things that I really want to understand is how do you evaluate a bank? How do you evaluate and how do you value a bank's capacity and growth? Is it poised for growth or is it a poorly performing bank? And what are the metrics? What are my metrics? I want to share you my metrics today. But by and large, over the patterns that I've judged and at least identified from all these banks, I can tell you that there are at least 4 or 5 buckets that I personally see that a bank would be directly, you can directly correlate a bank's growth just based on these 5 buckets. The first thing that I would be looking into is a bank's CASA ratio. And what is a CASA ratio? I would like to give you a little more of an explanation over there. CASA ratio is something to deal with current accounts and savings accounts. Now, CASA ratio is directly related to cheap credit for a bank. So, if you have cheap credit for a bank, the biggest amount of asset is the amount of deposits that are coming into the bank, right? And if the deposit growth is naturally increasing, especially within CASA accounts and which is basically the current accounts and savings accounts, it can use that credit for much more riskier loans, and it can use that particular amount of credit for its advances book, right? So CASA ratio, the higher the increase, the more improvement in CASA ratio. There's a very strong correlation for a bank to continue to remain profitable for the entire year, right? So that's the first bucket that I'm strongly looking into whenever I'm looking into a bank's profitability. If CASA ratio is increasing, then I can confidently say that the bank is poised for growth. The second bucket is the asset quality bucket, right? So we have loans, the advances growth, if advances growth is increasing, it doesn't just make sense that it's a good sign, right? Just because the bank is very aggressive in lending doesn't mean why it doesn't mean that the bank is poised for growth. It also has to make sure that the same loans are performing well for the bank, that monthly interests are being given back to the bank. Monthly interests are, it's creating a stream of income from the advances that it's lending to the customers, to retail loans, to commercial loans, to vehicle loans, to MSME loans, to agricultural loans, to big corporate loans. It wants to make sure that these banks are able to generate income based on the advances that it's lending to these to these various entities that I've just mentioned. So the moment one of these loans is not performing for a bank, it would be classified as something called the non-performing asset. So it would be considered as a non-performing asset, and it would be very detrimental for the bank because it would increase the GNPAs and the NPA ratio, the net NPA ratio and the gross NPA ratio. But what's even more important for a bank is to make sure that it restructures the asset. It at least incentivizes the people who are not able to perform, who are not able to give back the loan in the full amount. It at least restructures the asset to make sure that the bank at least gets back some amount of the interest it was supposed to earn, rather, from the loans it has been shared, the loans the advances that it's given to these customers who are not able to perform back in these loans, right? The fourth sub ratio that would be accounted as a part of the asset quality would be the you know provisional coverage ratio. Sorry for that. Yeah, the provisional coverage ratio. It wants to make sure that the higher the number of higher in the percentage of PCR, the provisional coverage ratio, the more it also signifies the strength of a bank to at least counter against bad loans, badly performing assets. So it wants to make sure that the higher the ratio of PCR, the more likely that a bank is it's able to counter against badly performing loans, as I've just mentioned. The third and fourth are very similar buckets. They are advances growth, which I've just mentioned, and deposits growth. These two are directly related to the first two buckets, which is the CASA ratio and the asset quality ratio, right? It wants to make sure that any bank to remain profitable over the long run, it wants to make sure that advances are increasing. It wants to make sure that it's aggressive in its lending, just so that it can continue remaining profitable for the shareholders, for the board, for the management, everybody. So the fourth bucket, as I mentioned, is the deposits bucket, right? It's of prime importance for any bank that it does not have high amount of wholesale deposits. What are the wholesale deposits? So let's give a small example. Like if you've taken an FD for a bank is extremely expensive. It doesn't want to give away too much interest for the consumer who is taking the FD. It wants to make sure that it gives the least amount of interest to the customer, just so that you could use that amount that you are lending to the bank for much more riskier lending. So if a bank is essentially giving you a 9 or 10% FD interest rate, it is good for the consumer, but it's not necessarily good for the bank, because it is not a cheap source of credit. It's a very expensive source of credit, is what I'm trying to say. So the deposits growth should continue to increase, but it can only and only increase within the CASA ratio. So that is very, very important for a bank to remain profitable over the long run. It has to increase the deposits growth, but it should only increase within the CASA accounts. Okay. The fifth is the profitability bucket, and this is the bucket that I would look towards the end, because the guidance of every bank, of every company or financial company, releases a set of numbers that it wants to achieve: a very strong NIM, which is the net interest margin, a strong return on asset, a strong return on equity. It wants to continue increasing its numbers within these 3 or 4 profitability ratios. But I would only consider looking into these ratios somewhere towards the end of the year, towards the end of the quarter, like the fourth quarter. I wouldn't look into it directly, because you can only say so much about profitability in the first 2 quarters. You can only see if the management is confident that it's able to achieve the numbers that it is mentioned in the guidance in the first quarter in itself. So these are 3 or 4 numbers that I would actually look towards the end. The profitability ratio that I was mentioning. And another number that I would really consider very deeply would be the cost to income ratio, which is basically the ratio of the operating cost, the amount of costs the bank is incurring versus the amount of operating income is incurring, it's achieving from these loans and everything that it's lending to these various consumers. So the lower the number, the lower the operating costs, the higher the profitability for any bank. So it wants to make sure that it's incentivized very deeply to continue to make sure that the cost to income ratio is as less as possible. It wants to make sure that as less cost as if it's achieving as less amount of costs as possible, just to continue to remain profitable over the long run. So here is my investment checklist for a bank to evaluate a bank whether it is poised for growth or it's a poorly performing bank. Until next time.